Happy Monday, everybody. I hope you had a great weekend. We're back to a full week. And today, of course, today is February 24th, 2025. And this is your Monday market update. We're back to having another Monday this week. As we do every week at this time, I want to review this past week and preview what's coming up this week. As the Friday video from 2 weeks ago called it, the Fast and the Furious, it continues. So let's see if we can keep up. After the President's Day holiday, the week started off on Tuesday with cautious optimism as investors digested a mix of upbeat domestic economic indicators and some lingering global uncertainties. Early gains were driven by a rally in semiconductor and tech stocks, supported by additional commentary from Bloomberg and Reuters, noting robust earnings in the tech sector and renewed optimism over the U.S.-China trade dialogue. However, geopolitical concerns, including uncertainty around ceasefire agreements in Eastern Europe and rising global bond yields, led to intermittent pressure throughout the session. Dip buyers did step in late in the day, pushing the S&P 500 to a new all-time high. The Dow closed just in the green. S&P was up 0.25%, record high, as I mentioned, record high close, and the NASDAQ closed also just barely in the green. On Wednesday, markets experienced steady gains as investors balanced mixed economic data with positive catalysts. The session was characterized by a moderate rally after soft U.S. housing starts and a cautionary global inflation report temporarily weighed on the sentiment. According to Reuters and CNBC, fresh bullish money flowed into the equities when investors reacted positively to hints of improved U.S.-China trade prospects. The release of Fed minutes, perceived as less hawkish than feared, further bolstered confidence, allowing the S&P 500 to hit new intraday highs before a brief pullback. At the close, the Dow up less than 0.25%, S&P 500 up about 0.25%, the NASDAQ almost the same as Tuesday, up just a little bit. Thursday was marked by heightened volatility and a shift in sentiment. A mixed earnings report from retail giant Walmart, which delivered favorable results but accompanied a cautious forecast, sparked concerns over consumer spending. Recall that just a week before we received a less than expectations retail sales report. Additional analysis from Bloomberg and Reuters highlighted that Walmart's 6% share drop sent ripples across the market, triggering a sharp early decline in the Dow. Sentiment remains subdued amid persistent controls over retail trends and a string of hawkish Fed comments. In contrast, the tech-focused NASDAQ showed some modest resilience. Closing returns, the Dow was down 1%, S&P 500 down almost 0.5%, and the NASDAQ was down only 0.5% also. Friday's session saw a pronounced sell-off as fresh U.S. data stoked fears over a slowdown and a slowing economy and sticky inflation. Investors, spooked by a series of negative indicators and the prospect of additional market-moving policy announcements from the Trump administration, shifted into safer assets as losses deepened into the close. On the eco data front, the University of Michigan Consumer Sentiment Index tumbled to 64.7. Now that's nearly a 10% drop, and the 5-year inflation outlook climbed to 3.5%, the highest since 1995. Existing home sales fell more than expected, and the U.S. services PMI slipped into contraction territory, further dampening confidence. On the earnings side, Walmart shares declined another 2.5%, the second day in a row of big losses for that stock, after the retailer, of course, as we mentioned, issued a weaker than expected forecast, reinforcing concerns again about consumer spending and the broader economic outlook. As I keep telling you, we collect sound bites from all over, and some of them get noted. This time, investor Steve Cohen warned of a potential significant correction, attributing to the weakness to proposed tariffs and the administration's cost-cutting efforts. Again, just somebody else talking. This all led to the defensive sectors as relative winners, the names like Procter & Gamble, General Mills, and Kraft Heinz, as investors rotated away from high flyers like Nvidia and Palantir. I'm sure you've heard me say it: toothpaste, toilet paper, cereal, and ketchup, they don't usually care about what the economy is doing. As at the close for the day, an ugly one, the Dow Jones Industrial Average is down almost 1.75%, 750 points almost. S&P down also about 1.75%, and the NASDAQ was down almost 2.25%. For the week, the S&P 500 did slide roughly 1.75%. The Dow and the NASDAQ each lost about 2.5%. By the end of the week, for those who want to have a technical take on the markets, all three indices closed at or below their 500-day moving averages. But before you go out and hang the fire sale sign, just note, we hit new highs this week in the S&P. A slight pullback, while worth noting, is not something that we have not been talking about. As markets keep creeping up, 2 steps forward often does lend itself to 1 step back. Before we get mired in that, let's take a look ahead to this week. This week, starting off a bit quiet, we're going to see a little bit of a bounce back today. It looks like it will be, at least on the open, it will be packed with a few big items and a few huge items. First, note that we're back on the Fed head parade. Logan, Barr, Barkin, Bostic, Schmid, Bauman, Hammock, Harker, and Goolsby. And to feed the Fed, although I remain in the camp that inflation is not our biggest enemy right now, the Fed's favorite inflation measure, the PCE, is out on Friday. We'll also get housing data, Q4 GDP, and jobs numbers. And to round out the menu, earnings, what I think is the key. Will growth keep going, or will it fall off a cliff? We know that we're losing momentum, but at what rate? We'll hear from Home Depot, Lowe's, TJX, Salesforce, Dell, and for anyone who's paying attention, we'll hear from NVIDIA. This has become the tell-all, as if AI spending is still going to be strong or not. So this will be watched very closely. You notice what I did not mention, and that is one of the other wild cards. I remind you that I believe we have three main risks: growth, that's earnings and thus valuations; geopolitics; and of course, politics. No longer about the vote, just about what's coming next. One last note for anyone trying to make sense of the $334 billion in cash that Berkshire Hathaway under the leadership of Warren Buffett currently holds. Come back on Friday for the planning video, and I will dive into some of those pearls of long-term investing wisdom that Buffett has put into his recent shareholders letter. Remember, these videos on Monday and Fridays are great and easy way to keep in touch with me twice a week on your schedule and without small talk. 5 to 8 minutes. I do all I can weekly to make it worth your time. Keep in touch, keep to your plan, and have a great week.